Welcome everyone, episode number 36 of the Wide Lens podcast. I'm joined here with my co-host John Sim, and we're going to cover the latest topics in financial markets this week. We're recording this on Friday, the 10th of March, 2023, and we've kicked off at on the dot, 10 a.m.
Perfect.
Nice. So let me kick off with a quick wrap-up market minute. I will get this chart up here now, which is the global stock markets over the last 5 days. This was really interesting to me. Let's have a quick look. The orange being the Australian market up about 1.5%. The blue is the European stock market up 0.9%. The red emerging markets up about 1%, and they're sort of flatlined, relatively flat. But what's interesting is the US stock market in purple up 3.3%. The Nasdaq up 4.66% over the last 5 days. And there's a huge disparity between the US stock market and the rest of the world, effectively, which just started to seem a bit weird to me. And I think a lot of that might be repositioning from what we saw during the month of February with some pretty poor numbers. But what I'll also then bring up here is the year-to-date numbers. And I think the year-to-date numbers are probably interesting to have a look at going forward. The Australian stock market in orange again, up 4.28%. The red, the emerging markets, and these are all done via Vanguard, iShares and BetaShares ETFs, 2.87% for emerging markets. The S&P 500 up, 6.6%. The Nasdaq, this blew my mind. The Nasdaq's up 15%, a bit over 14%, I should say, year to date, and the European stock market up 8.8%. So you can see there a huge sort of run out of the gates from February for the Nasdaq. What do you sort of boil that down to?
Oh, it's an interesting one, isn't it?
Just like massive sell-off that just rebounds?
Yeah, there was a massive sell-off starting last year, and that's really just coming back now, I think. That's probably it. We're
starting to see now, most other markets flattening out with everything that's going on in the market at the moment, with inflation just becoming pretty sticky and a bit messy at the moment. I think everyone had thought that it was going to be tamed. In the US, it looked pretty good, but the Australian market doesn't seem to have followed suit. I might just take the first topic, just leading off from the discussion that we just had. This is Bloomberg. I'll quote Bloomberg. Corporate bonds are doing surprisingly well at a time when equities and government bonds are buckling under the strain of a hawkish Federal Reserve stance. Credit is declining on a total return basis, but at a slower pace than other assets. Meanwhile, investors are putting plenty of money into corporate bonds as they switch out of equities. That may help explain why credit spreads, a key gauge for asset class, are narrowing even as the Treasury yield curve rings louder recession alarm bells. And I'll bring this chart up now. This is from Bloomberg. Credit is weathering Fed rate storm better than stocks. And so you've got the white line there, John, which is on the right-hand side, which is credit spreads. So you can start to see the credit spreads narrowing.
Right.
It going up means it's narrowing, not widening. And on the left-hand side, the purple line and blue line, the blue line are junk bonds, and I'll start again. The purple line, this took me a little while to work out what the hell's going on. The purple line is the S&P 500, referred to the left-hand axis. So you can see the index level.
Yep, makes sense.
The white line being investment-grade bonds and the blue line being junk bonds on the right-hand side. Both are going up, which is indicating spreads
the
narrowing.
basis point spread narrowing.
Correct.
So that's about, call it 87 basis points.
Spread on investment grade, and you got a bit over 100 on junk bonds. But just to put that into perspective, junk bonds had blown out in excess of 150 basis points back in middle of last year. So not even about 9 months later, that's down 30%. From those levels. So effectively you had a rise of 30% in your junk bond values. And then you've got investment grade, which blew out to about 120, and now we're sitting at about 97 at the moment. What do you think what do you think the reasoning behind this is? If people are pulling monies out of equities being a long-term riskier asset and putting it into investment grade bonds, is it because bonds are still now actually generating something?
That's right. Now generating returns, whereas previously they were on, call it close to 0 to 1%, right? And now you're getting 4+% return on investment grade bonds. So there's, I'll speak about this later in my other topic.
Yeah, okay. I don't want to take your thunder.
No, that's all right. But there's definitely a move to shifting to these higher yield plays.
I've got a few other charts I want to bring up. This one, bonds are saying Powell willing to break the economy. So the blue line is the 2-year Treasury yield in the US, and the white line is the 10-year yield. And you see the 10-year sort of stuck at about that 4% mark, but have a look at the 2-year Treasury yield. That's creeping up to 4%. That's how you start to get this inversion, which I'll talk about in a second. So this only started happening sort of back end of last year, but it's really blown out now.
So what's Powell actually saying? Is he saying he can't get inflation under control, and in the short term they're just going to have to keep going higher?
Yeah, the testimony the other day, my reading was that what's back on the table now is multiple and bigger hikes. I think with the 25 they did last time, I think the view was and the tone was that there's going to be less hikes, smaller amounts, but it feels like we're going back the other way now.
Increasingly hawkish.
Yeah. And look, rightly so, the data that's coming in, it just feels like to me that, sure, the inflation number's coming down from where it was, and that's great, but we're still getting some pretty solid numbers. We looked at job numbers the other week. They were just January was just blew it out of the water. And so we're getting economic data that is still bloody strong.
Yeah.
And so what the bond market is saying it should happen, and what is actually and what commentators are saying that we're going to fall into recession, we're going to blow the economy up, but that may happen at some point in time in the future. But what the economy is telling us right now is that things look pretty damn good.
So you think there's a no landing scenario sort of playing out?
Look, I feel like this whole no landing concept seems to be gaining more and more traction with every data point that that is released. Torsten Slock from Apollo, you and I looked at this, had this great chart that showed how the market has been increasingly wrong, specifically on employment data for the last 10 months straight.
Yeah. And
so it's almost like we want this thing to happen, but the economy still continues to punch out some pretty good numbers, some pretty decent numbers, and that's why I think maybe, I mean, having rates this high was kind of where we were pre-GFC.
Yeah.
I mean, what blew the economy up in the GFC and where we're at now, I don't think they're comparable for a number of reasons, which I don't think we need to go into today. But I feel like maybe, are we not normalized now?
Isn't it surprising how quick we adapt and normalize and anchor a certain price level? So once we've all got it through our heads that it's going to be higher for longer, suddenly, that new norm, you're right, it just normalizes. It becomes your baseline, and everyone just becomes bullish again.
So we went from cheap money to free money to cheap money to now, I don't know, what do you call this? Like
reasonably priced money.
Reasonably priced money. I'll bring this another chart up now. Again, thanks to Bloomberg, Australia's faltering economy faces further rate hikes. This is interesting. This is what I believe is a disparity between what is going on in the US versus what is going on in Australia. Traders expect the RBA benchmark to top 4% despite soggy data pulse. So for those watching, I'll explain the chart, and for those listening, I'll try and do my best. This is for the last 12 months, and what it has on this chart is the RBA expected cash rate in 6 months' time. On the right-hand side, you can see that's been getting higher and higher and higher, and it's north of 4% now. For currently, the effective RBA cash rate is in white, and has always been sort of a couple of steps lower than what the RBA expected cash rate is going to be in 6 months' time. And then on the left-hand side, you've got the City Economic Surprise Index. And that's been falling for the last 12 months effectively. And so what that's saying is that we're getting downside surprises on economic data in Australia. And I won't list them all now, but...
So what's that telling us? That when we're getting more surprises or less surprises?
No. So what it's telling us is that the surprise that... So for example, we might have... the market might have an expectation of employment numbers to be 50,000.
Yep.
The numbers came in at 25,000.
Right.
So it was a negative surprise, right?
Yeah. Okay.
A positive surprise would be the employment number was 65,000. So a surprise on the upside. And what this is saying is that there are more, and it's sort of an index of economic data points. It might be retail spending, might be employment, GDP, whatever it is. They're all now coming in lower than expected. And so that aggregate index is just now sloping lower. And basically what this chart is telling us is that we're starting to get some soggy data, but the expectation for the RBA cash rate continues to rise.
Interesting.
Quote the RBA. I'll just get rid of that chart. The board expects that further tightening of monetary policy will be needed to ensure that inflation returns to target and that this period of high inflation is only temporary. This is Lowy in his post-meeting statement. Yep. Any comments on that?
As we said, I think a couple of weeks ago, they're really trying to reduce this inflation number, and it looks like he's going to do everything he can to get it heading in the other direction, right? That's a long and short of it, really, isn't it?
Could there be, last week we talked about the US mortgage market and how 90% of the mortgages were fixed, sub 3 or 4%. Could the Australian market also for a short period of time somewhat resemble that of the US, meaning I think 40% of mortgages are currently fixed at the moment, and a big chunk of them are starting to roll in June and July of 2023 with a massive rollout of second half of this year. Could it be that still a lot of people have mortgages that are fixed at that rate? That could be influencing.
Currently, you're talking about
right now.
Yeah, I think so. And this fixed rate cliff that we all keep hearing is going to be a big determination as to how we move forward. So
this thing could really blow up, whereby the RBA keeps raising rates at the pace that they're raising. By the way, Bank of Canada paused the other day, so that was really interesting. I haven't seen many major central banks pause lately, but I wonder if they push the cash rate so high that it really paralyzes those fixed mortgages. I mean, not to say they're not going to be paralyzed now, but we're just really pushing them.
I mean, if you think about it, I was speaking to somebody the other day where their mortgage payment's going up $1,000 a week. And you're going, well, that's another $4,000 a month that, they would have had for discretionary spend or saving or schooling or whatever that now needs to go into their mortgage. So it's got to have an impact.
Although one thing we did see last week, I wrote about it last week, and this is from CoreLogic, showing the amount of refinancing that's going on, and what we're already. And I was speaking to a couple of brokers last week over dinner, and they were saying the banks are already. I mean, we're already seeing the cash offers, but they're saying they're cutting margins now, so they're cutting bespoke deals when you're looking at refinancing. So I reckon that's going to be. There's going to be a big game on, I reckon.
So if you haven't spoken to your bank, go speak to your bank and ask for a discount.
Go talk to a mortgage broker.
Or a mortgage broker,
to go and tender the deal, because I reckon that's where the game's at.
That's if you can get the same deal that you've got now.
Well, or if anyone would even lend you any money. This is from Bespoke. In assessing, this is further on from the RBA before I get into Bespoke. In assessing when and how much further interest rates need to rise, the board will be paying close attention to developments in the global economy, trends in household spending, and the outlook for inflation in the labour market. See, I reckon the RBA is really now saying, actually, maybe we might just need to take the foot off the gas here and really start to assess the potential implications of the decisions we've made to date for next month and the month after and the month after.
It's been going so hard and so fast. I think the numbers just haven't caught up yet.
I don't disagree with you. I'm going to bring this chart up now from Bespoke. It's the US Treasury yield, 10-year minus 3-month yield, just 1960 to 2023. We looked at the inversion before with the 2-year and the 10, but this is the 10 and the 3-month, which is probably more reflective of real short-term money movements. I'm just going to quickly read this, but it's for those watching, the chart's up there. Looking back at that period, we would note that after the 2s, 10s curve first inverted in October 1979, the economy peaked at the end of January, nearly 3 months later in January 1980. Despite the fact the economy went into a tailspin in the year that followed that first reading when the curve was inverted by more than 100 bips, the stock market was rather strong. While it was far from a smooth ride, over the course of the next year, the S&P 500 rallied almost 23%, the Nasdaq was up 36%, and the Russell 2000 was up over 40%. The two caveats here are, first, a small sample size of one is hardly enough of a track record to draw any conclusions from, and second, back in 1979, valuations were a fraction of where they are now. This is interesting. I found back then the S&P 500 was trading for just 7.3 times trailing earnings.
Where are we sitting at today?
Today, the S&P 500 trades at a multiple that's 2.5 times that level. So we're sitting at 21 times effective. Well, maybe a little bit less. I think it'll be less now. Yeah. Back in 1979, the yield on the 10-year was at 10%, which also happens to be 2.5 times the current 10-year yield. Time will tell how the economy and the market react to the current backdrop of deeply inverted yield curves. But back in 1979, the last thing most investors probably had in their forecasts was a 20% plus gain in the S&P 500.
So that happened the year after.
Let me wrap up this, before I wrap up this section, I'll bring up this chart that Bespoke had. US major index performances. So this was from 1979 to 1980 with that inversion they talk of. This is, you see the market fall back in, was it April of 1980? And you see that massive rally. S&P 500 up 23%, Nasdaq 36, Russell 40.5% over that period of time, which I found remarkably fascinating to see that. And everyone talks about high interest, high inflation periods through the 70s, and we see this the back end of 79 through the 1980s.
So there was a big clean out effectively, from that period of, call it Feb to March, and then a strong rally off that base.
Yeah, correct. Yep.
Okay.
Well, have depending on which inverted yield curve you look at, the Nasdaq was down 35% last year. The S&P 500 was down 22%. And I just wonder if that was the clean out.
Yeah, is that the clean out? Are we there yet?
Don't know. Finally, I'll share this one. This is from, who's this from? Jim Reed from Deutsche Bank. And they looked at and you and I have talked about this, when inflation hits 8%, and what happens next through history. So on the left-hand side, they use the high inflationary period in the 1970s, all countries. On the right-hand side is the 1920s. But let's probably just focus on the 1970s. They've got the interquartile range. 0 represents when inflation hits 8%. What happens after? And you look on the right-hand side of that left-hand pane, you've got the median outcome kind of following the interquartile, that light blue range. And then you've got the current and forecast for the US cycle and the Eurozone cycle. The red is the US, the grey is Euro, and it is clearly at the bottom end of that interquartile range that we've seen since through 1970s. And what the forecast is that that inflation is going to come down, probably the fastest pace that it's come down in history. Sorry, during the 1970s. And the 1920s is the same. You've got a lower bound current decline and forecast for inflation consensus. Any comments?
So this is just their prediction of what will happen based on these 2 points in time. It's
Bloomberg. So the dotted line is the consensus numbers. The thick line.
Who's a part of that consensus view?
You'll have economists, you'll have banks providing consensus view.
Right. So basically, they're going out of probabilistically this interquartile range zone.
Yeah, For the 1970s.
For the 1970s, but not for the 1920s.
Well, if you have a look at the US current cycle in the thick red, solid red line, it already has. It's already breached that lower bound.
So, I mean, what this is saying is the median is a lot higher.
For that period,
period.
It looks like...
So, potentially the consensus view is underestimating how inflation will go going forward.
Potentially, but so far...
That's how I would read it.
Yeah. And
potentially.
Yeah, maybe you're right. Who knows? I mean, that's why we've got that's why we've got a range, right?
Yeah. Look, and I mean, it could just end up being higher for longer, right?
Which is a no landing scenario that you and I talk about.
Yeah.
And others are obviously talking about. And you see that blue line, which is inflation, a lot stickier than what you think it is.
Yep.
But I would say in both counts through the 70s and 90s, if you compare current to then, we're at the lower bound on both of those periods. Time will tell.
Time will tell, and I think, look, if that happens, that's great for interest rates. Interest rates will probably head down, but if we're more along where the median's going to be, I think we'll be at higher rates.
Yeah,
for longer.
sure. Yeah, but so far, I'll take what the data says. And I'll take the consensus viewpoint that we're probably going to continue on the current trend.
Smarter people than you and I.
Mate, the consensus is always wrong though.
Yeah.
Anyway, let's hand over to you. What do you got?
Yeah, well, we've got funds and fees right now. So an interesting article in the AFR. Private debt funds boom, but upfront fees divide investors. I mean, this very top
AFR
from the AFR. Yep. Pretty topical. I mean, there's been a rise in alternative investments recently, and obviously you and I running the Ecom Capital Income Fund. This is front of mind for us. What sort of fees are everyone charging, and is that appropriate, right? So, I mean, look, in Australia anyway, it's a pretty opaque world. Fund fees are, they charge in combination, right? You've got management fees, you've got performance fees, you've got fund fees, you've got fees that are being charged in addition to all those fund fees to the borrower for originating and managing deal flow. So every fund manager is doing it different in terms of how fees are allocated, and there's basically not much consistency at the moment in terms of how fees are allocated for what funds and how transparent some funds are, right? So you might be investing in a credit fund, for example, where they're charging you 50 bips on the fund level, but then outside of that fund level, on the underlying deals that they're doing, there's a bunch of other fees being charged that you've probably got no idea about.
The investor has no idea.
The investor would have no idea about.
Why do they have to have an idea? Why should there be consistency across funds?
Well, it comes down to, how much economic value is being added, what value is being provided to you and at what cost, and what risk are you taking for that value, right? So, a lot of investors wouldn't be able to assess that. They're just looking at gross returns and nominal returns and what they're getting at the end of the day and going, well, are we happy with 5%, 6%? Well, maybe. What risk are you taking for that 5 and 6%? And I don't think investors are looking down to that level of detail, going, and assessing. I mean, the devil's in the detail, right? So assessing what's actually happening at that fund level and determining if that fee is appropriate.
What was the viewpoint of the article?
Look, I think the bottom line is, that there could be more transparency with fund fees. There's obviously lots of costs to a business to originate these transactions. Marketing, overhead, staff, and
but shouldn't that be covered in the management fees?
The management fees from the capital side. So there's a amount of work that needs to be done on the capital side to ensure that investors' money is being well managed. Compliance aspects being completed, all the accounting and administration from a capital perspective is being done. But then there's also a fee for originating transactions, which takes a lot of sweat and experience to be able to put together and package these transactions up, right? So, some managers are keeping those fees separate, and there's other managers that are combining them and saying, well, we'll take a performance fee instead of instead of taking these upfront fees from borrowers and packaging that all together and saying, well, if we deliver more value, we'll just take a proportion of that outperformance.
Right. But why does there have to be a consistency? Is it for the benefit of the investor to understand?
I think it's for the benefit of the investor to understand, is there alignment to their investment manager when they're investing in these vehicles? Are we reaping all the benefit? Is it being passed on? I don't think anyone's really averse to paying more fees if that's due and payable. So, everyone needs to make money to win, right? But it's working out, I suppose if there was a transparent and free market, the market should then dictate where the fees should be, right?
Do you think it's not, or do you think it's still quite immature and opaque?
Yeah, I think not all investors get access to the right opportunities, so there's no real free market for them to really assess, where the fees are. It's not like there's a website that goes into every single fund line and says, hey, these ones are charging the lowest fees and are the best risk-adjusted return for your money for investing in this asset.
In this article, I quote, non-bank lender metrics credit partners, for example, may, air quotes, get fees from borrowers, but such fees would not impact on the trust's returns. MCP said in a disclosure statement for its listed master income trust, MCP may receive additional fees from the borrowers of the relevant loans of the MCP wholesale investment trust and wholesale funds, the firm said in a statement which was viewed by the AFR. These fees will not be paid from the assets of the trust, but will be paid by the borrower to the MCP. These fees will not be a cost to the trust and do not affect the returns of the trust.
Correct. Yeah. So basically, if you're happy to get 5 or 6%, then it doesn't matter what additional fees they're charging elsewhere. You're still going to get your 5-6%.
So is Jonathan then Shapiro? Not Shapiro. What's he saying though? Is he saying that those fees, I haven't read the full article, should those fees be pushed down to investors, or he's saying it should be standardized, that you should be able to charge this much, not charge that much?
Or should be transparent in the way that they disclose those fees.
Gotcha.
So there's no
you put it out on the table.
Yeah.
And what's your viewpoint on
that? Well, look, a lot of these transactions are bespoke, right? So you'll arrange those upfront fees at the deal level based on how much work that deal is, right?
Who are you going to disclose it to? These are private transactions that are done with private people who, and that's why it's called private debt, whereby you can't disclose these things.
It's very hard.
How do you then?
I mean, then you're just going to have effectively a cookie cutter machine where for something that can't be cookie cutter, right? It's bespoke. You're not doing something cookie cutter. So yeah, it's very hard. And look, courses for courses. I think there are some funds
Horses for courses?
Horses for courses. You like that?
You said courses for courses.
Did I say courses for courses? Horses for courses. But some funds are able to do that as they're less bespoke and they can be more transparent around the fee structure.
And if funds want to pitch that as their value proposition or their
if you're delivering significant alpha in terms of what you're doing, I think you should be rewarded for that.
Shouldn't that naturally bring the investor to you? Like, to your point, the free market, if one lender or manager wants to push it out and provide that transparency to their investors and take a performance fee instead, wouldn't the free market naturally gravitate towards that if they do a good enough job?
You'd think so. And some managers are doing that. And I think it works quite well for them.
Anything else you want to add there? So what's the bottom line for you? Do you think there should be the transparency, or is it just something that just can't be done? It would be nice.
Look, my preference is just alignment, right? If a manager's generating alpha for you, then they should be able to reap the benefits of that. Yes, there probably could be more transparency, but they should be rewarded for that and not felt, dirty for taking more fees if they're providing value. So that transparency in terms of alignment, I think if you have a performance fee structure there, probably does work well where, everyone makes more money.
Right?
Yeah, it's a win-win for everyone.
Yeah. Okay. Is cash really king? Now, I had to bring this up because I couldn't, I just couldn't digest it. I had to be in my bonnet for 1 week. I was WhatsApping you about this.
I know you were.
So this is the article. This is from the AFR, Chris Joy. If you can't earn 9%, you're better off in cash. To allocate to anything other than cash and high-grade bonds, he's a high-grade bond manager, by the way, for full disclosure. You'd want to be paid a risk premium of 4 to 5%. In the article, he goes on to say, with global cash rates rising above 4% to 5%, many highly rated government bonds offering 4% to 5%, bank deposits paying 4% to 6%. I don't know what bank deposits are paying 6%, by the way. And bonds paying as much as 6% to 7%. Well, what type of bonds are they? I suspect they're
junk bonds.
They're not senior bonds. The minimum hurdle rates for all other asset classes have soared. The minimum hurdle rates for all other asset classes have soared. And we've...
Yeah, I mean, I don't disagree with him that there should be a premium. And, you know, we charge the RBA cash rate plus 5%. So, you know, that's sort of... I don't think that's too bad a formula. But sorry to interject. I just...
there need 100%. There needs to be a hurdle rate. It's a risk premium. It's a premium that one would expect to receive over something else for the risk they're taking on and be compensated for that risk. It doesn't always pay off, but you need to have the opportunity and the prospect of earning something greater. And we've already seen in the charts before whereby people are pulling money out of equities. And the reality is in the US, your real dividend in the US is equivalent for the first time in, I think, since early 2000s. It is the same cash return as is the 6-month deposit in the US.
Right.
CD, cash deposit.
Okay.
So as an investor, what do you do with that? With rates rising and that being a drag on long-term assets such as equities, and you're seeing returns come down, and you can get the same return for far less risk, people are taking money off the table. And so he's right, the hurdle rates increased. But to go on and throw some of these numbers out, I think is insane. To earn 9%, you're better off in cash. I mean, that's I mean, the editor's obviously coming up with a pretty punchy and catchy
quite
headline.
Inflammatory, yeah.
But, you know, that's... Do you think that's realistic? I mean, it is realistic. Sorry, I shouldn't ask if it's realistic. But how does the everyday investor reading the Australian Financial Review, and I think this is really important because this is not the first article that's been written by Chris Joy, who I think super smart guy. His logic and thought process and methodology, I think, is incredible. But to sensationalize with these headlines, and when you read the article and to talk about bank deposits paying 4 to 6, I don't know, unless it's, I don't know.
There is right now.
Goldfields Mining Bank. Like, who the hell's paying 6%?
No, there's some majors paying that up to certain hurdles. So
up to $10,000.
I think 50.
You're telling me major banks are paying 6%?
100%.
I don't believe you.
4.5.
Mate, 4.5 and 6 is different.
I'm not saying 6. Yeah, 6 is pretty
bank
pretty
bonds
aggressive.
Paying much as 6 to 7%.
Let me look this up.
Bank bonds? What seniority in bank bonds are paying 6 to 7%? Subordinated. I guarantee it's subordinated debt.
Yeah, probably.
Yeah.
Oh, here we go. Here's one from UBank. Earn 4.6% up to 250 grand.
That's not bad. That's pretty good.
Here we go. 5.15
from
up to 50 grand from Bank of Queensland for people aged 14 to 35.
Because the guy that's got the 15-year-old's got 50 grand in his bank
to put
account.
in. Yep. What else? High interest saving. Here we go. Another one. Rabobank, 4.75% on balances up to 250 grand for 4 months.
Are they for 9-year-olds?
New customers. Great Southern Bank, 4.5%.
Okay.
On balances 100 grand to 750 grand. So you can at least get 4.5.
Okay, point taken. You get 4.5. I don't know what banks are giving 6%.
Six is.
I think that's stretching it.
outlandish.
6 to 7% on bonds. I don't disagree, but I think what's really important here, investors really need to understand what. This is my opinion.
Yep.
What risk are you taking
100%
for that return? And so if you can get 6% in a bank deposit, according to the article, Why on earth would you go and buy a subordinated bond for 6%?
100%. Yeah, you wouldn't.
If you're getting bank deposit 4 to 6, I think there needs to be another 250 basis point risk premium for bonds.
I agree with that. 100%.
And so, in fact, you're not being compensated sufficiently if you're buying I'm telling you it's subordinated. I know it's subordinated because ANZ's
read it.
subordinated notes at 6.5%, right?
Yeah.
And so if you can get 4.5 or 5% in a term deposit, why the hell would you go and take risk on a subordinated note for another 150 points? I think that's ludicrous.
No, I agree with you.
So I think what's really important here is investors need to understand what risk are they taking. I don't think most investors understand the risk they're taking.
No. And what's the appropriate risk-adjusted return?
Correct. For me, the bottom line here is that, and I'll just share something which I found hilarious. I didn't write this, by the way. In fact, I'll bring this up now. This is from the Kook, Stephen Koukoulis. Can't pronounce this. Sorry, mate, if I've just
Butchered
your surname. Koukoulas. It must be Greek. So the first article was published by Joy on Twitter. If you can't earn 9%, you're better off in cash. Pleb Capital says, so definitely not negative yielding leveraged real estate then, the Kook? And the Kook responds, and I thought this was just gold. Just checked, but Chris's bond hedge fund has returned an annual average of minus 2.02% for the last 3 years. Less 66 basis points of fees per annum. $100 invested 3 years ago with Chris Joy's bond hedge fund is now worth around $92. And then he goes on to say, I thought this was just the mic drop. If you can't earn zero, you're best keeping quiet, I would suggest.
Ooh, it's a bit of a...
Yeah, just a right
hook. Yeah.
On that one.
That's probably fair enough comment though.
I think that is fair. And look, I've looked at the funds of Coolabah Capital. They're not returning 9%. So if your funds aren't earning 9%, do you just pull? I mean,
if you're negative yielding on something that's supposedly very low risk. Yep.
So I think for investors, the bottom line for me is what people say and what people actually do are very different. Mouthpieces that are just talking away on social media, on crazy people on podcasts, and how they're actually managing money, I think on two different planets. Nassim Taleb once said, don't tell me what you think, show me your portfolio. And I think, I would say, to anyone making these claims, I don't want to hear your bullshit. Like, show me how you're investing money.
Yeah.
That, to me, is the bottom line. And I think that's what investors need to look at. I'm done on this rant. I feel a bit better about myself.
Maybe there should be a box next to your podcast or whenever you write an article to say how you've performed. As an expert speaking on this topic, right?
Yeah, I mean, you look at the last article that was written about bonds, and basically Chris is pushing the ANZ subordinated note as a bank bond. And great, yeah, bank bond sounds really secure, but what the hell's the seniority? You're getting 6.5% for a subordinated note.
Sitting behind everyone else.
You know what's going to happen when shit hits the fan? If that's the pitch to why you should buy the subordinated note, dude, you're at the back of the queue, man. You're not.
You'll be converting to equity.
You're gone to equity
at probably cents in the dollar, right?
So I think people need to understand the sequence of events and how the market works and what triggers cause other things, second order, third order effects, and don't just buy don't just buy a face value pitch or headline that you're reading. So anyway, I'll breathe a sigh of relief.
Yep.
And
let's move to show me the money.
Hand over the baton to you for this one.
Show me the money. So this is the wealth report from Knight Frank. So if we pull that up. The headlines, the recalibration. Optimism for wealth creation in 2023 is high despite turbulence aggregate decreases seen in 2022, with 69% of attitude survey respondents expecting their clients' wealth to increase this year.
2023?
In 2023. So the attitude survey, that was done in November 2022 by more than 500 private bankers, wealth advisors, intermediaries, and family offices around the world. Yep. So all their ultra high net worth clients, some of the banks participating: ANZ, Bank of Singapore, Citibank, CBA, HSBC, Standard Chartered, some other big names. They also, Knight Frank does a pulse survey as well. So that's got, again, the views of another 500 high net worth individuals from 10 countries and territories, including Australia, China, France, Hong Kong, Italy, Singapore, Spain, Switzerland, UK, and the US. And that was conducted in January 2023. So they've got a good cross-section of the high net worth and ultra high net worth market
could they have been
just
surveying. Uber bullish in January because the market just went on out of the gates on a tear?
Yeah, I mean, these guys managed 2.5 trillion in wealth combined under those that were surveyed, and yeah, they could have been bullish then, but so what's happening is, despite macro headwinds, geopolitical headwinds, private investments still remain pretty robust. In Asia Pac, they're looking at growth for high net worths, while in Europe and America, understandably, with the economic slowdown that's happened over there and higher US interest rates taking its toll, they're looking more at capital preservation. So
Europe and US are looking for capital preservation.
Most their high net worths that were surveyed.
APAC's
looking for growth. So
that's interesting.
Really interesting. And why does that matter? I mean, half of high net worths surveyed are looking to increase their portfolio in 2023. So they're seeing...
What do you mean increase their portfolio?
Yeah, so I'll just bring up this graph. If they've surveyed a high net worths to allocate their wealth.
Gotcha.
So if you look at changing tack, you'll see that 47% of those surveyed are looking at increasing their investment portfolio this year in 2023.
Gotcha.
There's been a big pivot to cash reserves, and that touches on your point of credit spreads and high grade bond yields. So 46% of those surveyed want to increase their cash and cash reserve holdings.
So half of them are wanting to increase the portfolio, the other half are cash reserves.
Cash reserves.
So that's interesting, where you've got it's split down the middle effectively.
And if you look right down the bottom to level of debt, obviously because interest rates have been rising, 29%, there's been a big increase in people looking to reduce their level of debt.
A third.
So look, it gives you a really good flavour in terms of what people with money are looking at doing. Obviously, with COVID and restrictions in travelling, overseas travel has been a top priority for the ultra wealthy.
What's standing out for me is holdings of residential property, holdings of commercial property. Look at the decrease, 15-16%.
No, yeah, most people are holding. So I mean, these are the people that can afford to hold, right? They can afford the land tax.
It's not a good weather bellwether.
It's not a great bellwether. And you're looking at 32 and 28% respectively, looking at increasing their holdings in residential and commercial property.
What's that potentially taking advantage of any opportunities?
Opportunities in the market. So people with money are still well poised to take advantage of the market. And if we look at this second portfolio makeup graph, portfolio makeup on average, total wealth, primary and secondary home, 32%. So that's the biggest portion. Equities, again, another big portion at 26%, and then commercial properties, 21, bonds, 17, and then the list continues to go down. But Knight Frank, obviously, very real estate focused based. A lot of the paper, which I encourage everyone to have a read of, we're talking about investments in residential globally, and that being a big part of ultra high net worth investment strategy for the year of 2023.
Is there a decrease from like commercial and like a shift from commercial to residential? Is that?
Yeah, they're just seeing opportunity for investment in that sector. It's looking at that as a safe asset class to invest in. I'll go. I'll have another graph a bit later on, which I'll go into, and that sort of ranks why they think that. We can probably pull that up now, actually. So if we go down to residential property and how high net worths view it, they view that as the safest asset class at the moment. So residential property is higher than gold. Gold is second, and then bonds third, commercial property fourth, equity markets fifth, and crypto sixth. So, as you know, number one being the safest and least volatile asset class, and you know that makes sense. In you know, everyone in Maslow's law, everyone needs a place to live, right? So you know, it's you know, one of those things that is not negotiable. You know, and people are seeing value in that.
That chart's interesting.
Yeah, really interesting. So bottom line is, you know, healthy activity in global markets is still on the cards for 2023. People are looking for opportunity, and you know, speaking to a couple of high net worths over the course of the week, actually, you know, what they've been saying is, you know, they're looking past these rate rises, right, and they're saying things will eventually stabilize. So let's look past that. Let's look at the opportunity, you know, past this hump of you know, interest rate rises, and they're seeing there's, you know, opportunity going forward.
I think the market is coming to a point, and we read that in the RBA statement where they said we're going to be looking closely at economic data, employment, and so on and so forth. So the RBA is well and truly aware of it, and if we're getting to the sort of tail end now of rate rises, and we may very well just sit here and just hover for a prolonged period of time. And if that is the consensus viewpoint, clearly it's not, because we're shooting north of 4. We're not that far away.
No.
Maybe we've got another one in there, right? And investors now understand where the playing field. Investors did not know what the playing field was back in August, September last year.
That's right. Yep.
Clearance rates in property were non-existent. Nothing was on the market. Nothing was selling. Nothing was moving. And if you think about the uncertainty of the investor at that point in time versus now, we're not saying that rates are going to get cut. We're not saying that the RBA is going to start cutting rates and everything's going to get better all of a sudden. Just the playing field is now a lot clearer.
Yeah, that's right.
We've sort of,
people can make decisions.
Yeah.
Yeah.
That's in my mind probably the best case scenario. I think the rate cutting that's not an option at this point in time.
Yeah.
You got anything for director's cuts?
No, I didn't really have anything this week.
All right, I'll bring up this tweet. Tell me what you think. 7 News. It will soon be illegal for landlords to kick tenants out of their homes at the end of their lease without a reason, in a major win for New South Wales struggling
It's just
renters.
ridiculous.
So
that's your property.
Yeah, no, you can't. You can't. Unless you've got good. What's the good
It's
reason?
out of control.
Like who determines what a good
That's
reason
right.
is?
Well, when we had a tenant in our place, and when we wanted to move back in, we had to do a stat deck to say we were actually moving back in to be able to kick them out. You know, this was mid last year, so you know, we're not too much better in Victoria, to be honest. But
read this quote from Caitlin Cadder. A law should be made for rent increases as well, especially unreasonable ones that are done because of rise in interest rates. A tenant shouldn't be financially responsible for their investment.
we're living in some sort of communist socialist society?
Mate, like
there should be free markets, right?
If I go to the shop and the price of my apple has gone up because of interest rates and
supply chain,
and the grocer had to increase his price, am I going to say to the grocer, fuck you, man, I shouldn't be responsible for the decision you made to go into the fruit business?
Exactly.
Mate,
this is just crazy.
Basic economics.
Crazy. This is out of control.
It is out of control. And look, I'm not saying that everyone's doing it easy, and obviously there are many people that are not doing it easy, and that's why we've got all these rules and laws, and you know, for those that can't afford, we provide housing. And,
we have one of the best social support systems
100%.
globally.
But look, I don't want to get too down to that rabbit hole. But I just found this to be a bit over the top.
I think so. It's out of control.
On a lighter note, let's wrap up with tips and recs. What do you got?
Tips and recs this week. Ooh. Where'd I go the other night? I went to Oldie But Goodie.
What's that?
Cumulus.
Oh, you went to Cumulus. I thought the place was called Oldie But Goodie.
No. Yeah, went there for dinner the other night.
I haven't been to Cumulus.
I haven't been for many years.
Are they
and
still
it was fantastic.
They're looking down on everyone still.
All right. Yeah, probably. I sat at the bar. It was nice. We had a chat to the chefs and just a good vibe.
Was it still expensive?
Still expensive.
I haven't been there in years.
No, it's still very good.
My mortgage rates have gone up. I can't.
Well,
Was it packed?
It was packed.
How like this is the
packed.
thing. This is the thing. What everyone's talking about, doom and gloom, pessimism, confidence levels down. Oh, meanwhile, Cumulus is packed.
Well, people are still willing to pay for entertainment, right? And we saw that in the last set of GDP and inflation numbers. Entertainment and retail is still one of the biggest drivers of inflation. I can't get out for less than $100 for a meal these days with two people. It's out of control. And and the portion sizes are getting just smaller as well.
Shrinkflation.
So yeah, it's but it was still delicious.
Wait till your kids get older, man. You just forget about it. You're like, we're not going out.
No, we're just going for Woolies roast chicken. That's it.
Remember when we were talking about like a few weeks back on one of the episodes where inflation was blowing out for like olive oil and retail and the pizza index. If you go out and buy the pizza, it's cheaper to make it at home.
Unbelievable. Yeah.
Have you made pizza in your Gosney?
I haven't done so for probably 4 weeks now.
Yeah, right.
So I'm due to have you over for a pizza night.
Yeah, okay. I look forward to that.
Yeah.
So talking about people still spending money, we went to the air show on Sunday last week, and I've never been. Have you been to the air show?
No.
Did I tell you I went to the air show?
Yeah. You told me. How was it,
mate? It's like nothing that I've ever been to before. It was insane. First of all, it took us 2.5 hours to get there. No, I'm sorry, 3 hours to get there. It was bumper to bumper to bumper. Like the West Gate was fine, you get over there, but when you get like towards Lara and there, and trying to get like around Avalon, like there's this, you have to follow a certain way, and we were in the Geelong overflow car park, mate. This thing is just, I just couldn't even just comprehend the amount of cars and people that were at this thing. It was sold out. Saturday was sold out. Sunday was sold out.
I heard they had to refund tickets.
I heard that as well. They were refunding tickets.
People couldn't get in, or there was delays everywhere.
Mate,
and people just missed
chaotic.
out.
It was hot, and I don't know. That's actually the first time I think I've ever been to Avalon, and mate, it's like there's just dust storms everywhere. It's windy. It's red dust.
It's more cinematic with all the planes flying by and the dust spinning everywhere, just like Top Gun.
No, it's not. Unless you buy a gold ticket, you can't go on the you can't see the tarmac. It is inflation.
There you go.
Right? And I didn't know about this.
How much is the gold ticket?
I can't remember.
Yeah.
No. But under 15 kids are free, which I thought was pretty good.
Yep.
We paid general admission, which was $89-$90 a ticket. But I was thinking about I sent you a photo. I said, what recession?
Yeah.
Mate, it was sold out. It was packed.
Kids loved it.
They got over it. It was just too much.
Yeah.
Like the energy there was chaotic energy.
Yeah.
People there's nowhere to sit.
Yeah.
There's no green grass.
Oh.
It's just dirt and dust and noise but man, these fighter jets, once these things turn and the arse end is facing you, your whole body just vibrates, and the noise, these things just flying at these things fly at 1,000 kilometers an hour.
Amazing.
I've
seen Maverick 3 times now because it's just in IMAX. It's just amazing.
I can't imagine just the G-force when you're the pilot sitting in there, and when they're just doing their loops and then they're free falling. I'm like, man, is this guy is he doing that on purpose, or is he actually passed out?
9 Gs.
Yeah, just going down. So look, if you, I'd 100% recommend going, but next time, 100% I'd go on a Friday.
Yeah.
Take day off work, go on a Friday, pull the kids out of school.
Yeah.
Hopefully no one from the school's listening to this. Pull the kids out of school, get gold tickets.
Yeah.
Because the gold tickets allow you to go into like a stand.
Right.
Like a soccer stand.
Yep.
And you see the planes landing and taking off the tarmac. And these things are beasts, like these massive planes that are like almost like war planes that carry like equipment. People, it's just These things are jumbo size, man.
Fantastic.
I don't even know how they get off and the speed they fly at. But anyway,
Good fun.
we weren't there for that long, but I was in the car for almost driving for 5 hours on Sunday.
5 hours with the kids in the car.
Yes.
Good effort.
Yeah.
Good effort.
Got them a Slurpee on the way back, so that shut them up for a little while. All right. Anything else? You
No,
good? All
all good.
Let's wrap up. Hit us up on YouTube, Spotify, and we're posting all the stuff on LinkedIn as well. So check us out. We'll catch you next week. My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526-798. The information contained in this podcast by me and or our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.